Our keynote speaker is Tad Rivelle. He's the Chief Investment Officer, Fixed Income at the TCW Group, overseeing more than $160 billion in U.S. fixed income assets, including $100 billion of fixed income assets in mutual funds. Prior to joining TCW, Tad served as Chief Investment Officer for MetWest, a independent institutional investment manager that he co-founded after spending time at both Hotchkiss & Wiley and PIMCO. He holds a BS in physics from Yale, an MS in applied mathematics from USC, and perhaps most importantly, an MBA from the UCLA Anderson School of Management. Please join me in welcoming Tad.
Thank you. Well, thank you. Of course, the last presentation of the day about bonds, I'm not sure who had the good sense of humor to subject you all to that, but nonetheless, what I think I'm going to do is maybe share some of our thinking about how active fixed income is properly or should be managed, and then focus mostly on where we think we are in the cycle, because the theme I think that you're going to hear recurring over and over again is the importance of being cognizant and conscious of what we consider to be essentially a now integrated asset price, credit, business cycle, something that I think has developed over the course of the last couple of decades. As I share our views, you may hear some very strongly worded opinions from time to time, and our role, of course, is not to force-feed views on anyone here. The intent is simply to share our thinking, and to the extent to which others would like to articulate contrasting views, those are always welcome. I think we're always better when our views and our thinking and our data, for that matter, is being challenged. So with that, what I'd like to do is basically begin by having a kind of a conceptual discussion about active fixed income management. Maybe it applies in general to the more active space. What we put forward, and I introduced it a moment ago, is that I think what a lot of folk miss in terms of talking about risk-on type strategies, risk-off type strategies, is that what gets lost in the sauce is to recognize that of this now integrated business credit asset price cycle that I alluded to a moment ago, 80% of it I think can be pretty well characterized as releveraging. And during the releveraging phases of the cycle, which, as I said a moment ago, is the dominant period of time, almost anything that you do that is risk in terms of its orientation tends to work out pretty well. And you can add value and generate returns for yourselves and for clients in a myriad of different ways. And even when you make mistakes, probably no one's going to know it, because the key element during the releveraging phase is that there's always someone who's willing to step into your shoes and assume the risk maybe that you probably shouldn't have had. However, it is a cycle, and so consequently at some point you get to that last 20%, and nobody basically rings the proverbial bell and tells you that this would be a good time to start getting defensive. So you, as the active manager or the manager of your own portfolios, have to start thinking, is this really, do I really want to continue with the same risk budget that I started with 5 years ago, 7 or 8 years ago? And so our point here is that if active management is going to mean anything at all, it means that you have to actively manage your risk budget. So with that perspective in mind, it basically begs the question. So we talk about cycles and how are we supposed to judge them. I think what this chart is meant to communicate in an oversimplified way is our thesis in a single graph. And I'm going to elaborate on this a little bit more. But the point of this thesis is that it's kind of interesting that what you're seeing with the blue line is aggregated asset valuations, and with the orange line is you're seeing aggregated income, which is to say GDP. What we have seen over the course of the last couple of decades is that we have approached periods of financial and economic instability when asset price growth gets very disproportionate to aggregated measures of income growth. Now, that's just an empirical statement. It seems plausible on the surface that maybe things should get less stable as asset prices expand. When you think about it in a more atomized way, higher asset prices in the equity market simply means higher PE ratios for given levels of profitability. It means lower yields in the bond market, so lower levels of income for comparable levels of interest rate or credit risk bearing. But I want to explore this in a moment as to why we think that there's actually a very powerful fundamental linkage, which I think has largely been missed by the academics and a lot of the mainstream thinking on, in finance over the course of this time. I want to also emphasize that as you go into the later stages of the cycle, that you tend to know it when you see it, because what you start to find is that investors start to rationalize risk-taking not by reference to fundamental type of arguments. What you don't hear, for instance, is that PE ratios are really low and that's why you should be involved in the equity market, or that credit spreads in the fixed income market are very wide and very disproportionate to the actual level of risk. Instead, what you hear is what we present over here, which is if it's at the end of the 90s, we remember what the story was. Don't pay attention to profitability in the equity market. What are you, some kind of a dinosaur? The only thing that matters are mouse clicks and eyeballs. In the last cycle, there was this narrative that home prices, okay, sure, home prices are really disproportionate relative to income, and who cares? Because, of course, there's no such thing as national real estate recessions. Ask any Fed governor. We now have subprime lending, and so the lay of the land has completely altered. In this cycle, the story is a little bit more subtle, but it's there. It's essentially that why worry about getting defensive? Risk-taking is essentially being licensed by the central banks, and the central banks will always have your back. They will lower rates. They will launch some form of asset purchase, quantitative easing. So don't, so to speak, worry your pretty little head about a possibility of an extended and severe deleveraging bear market type of event, because the central banks just aren't going to allow them to happen. The question I think you're supposed to ask yourself is that even if you believe that, that doesn't sound like a very fundamentally grounded type of argument. And once again, maybe that tells you is that if it's not fundamentally grounded, you're probably pretty late in the cycle. What this chart attempts to delve into analytically is to explore this potential relationship between outsized asset prices and why you may ultimately approach periods of financial instability. The narrative at the top, even though we describe it as the Fed's narrative, it's any central banking narrative, and with all due respect, it tends to be the academic narrative as well. And it basically goes this way, is that we had the financial crisis, it's a terrible time, 2008. We, the central bankers of the world, have to essentially step in and save it. And the way we save it is we have to do something extraordinary. We have to take rates to zero, we have to make them negative. And you know what's going to happen, according to their narrative? This is going to promote a reach for yield. And as you have this reach for yield, you're going to systematically suppress capitalization rates. So capitalization rates come down in real estate, they come down in stocks and bonds, and asset prices naturally, tautologically go up. And then according to the central banking narrative, just you wait, when those asset prices go above some magical threshold, we're going to have a virtuous cycle of renewed spending and investment, and then we can go and normalize rates. And it's an interesting theory. Problem is that it's 8 or 9 years later, and where is this virtuous cycle that we've been promised, and where is this normalization process? The answer is it's nowhere to be found. Now, why is that? Well, the way I sometimes put it a little bluntly is that it is often the case, I think, in adult life, that people will rarely basically tell bald-faced lies. But what they do is that they speak half-truths. Oftentimes they believe the half-truths. And I think that what we have heard from the central banks is a half-truth. The part at the bottom is what they leave out, which is essentially when you have higher asset prices, particularly when you have created them artificially by artificially suppressing rates and artificially suppressing capitalization rates with it, you have another dynamic, which is, again, maybe putting it very simply, is that if you double real estate prices in the system, then you have twice as much real estate to lend against. You double the system-wide collateral. Channel your inner community banker. If real estate valuations double wherever place you want to put into the narrative in Beverly Hills or whatever, what you have done essentially is you've increased the amount of collateral that is in the hands of people who live in Beverly Hills. And if you're a community banker there, well, that means that according to similar type of underwriting standards, you can write twice as many loans. And so the result essentially is that as the Fed has, or as central banks have artificially increased the amount of loanable collateral, what happens is that the private sector starts to fill it in. So the trajectory of your asset prices starts to go up asymptotically. With a lag, so does your leverage. And the result ultimately is that you have an economy that appears to be having misused a lot of the credit and leverage that's been created. Now, how do you know it's been misused? Because of all of the leverage that's been created, if there was actually a lagged future benefit associated with the loans that were taken out in 2010, 11, 12, and 13, you should be seeing the benefit of those efficiently allocated loans, if in fact they were, or efficiently allocated credit, in the form of accelerated GDP growth. There's no point, obviously, in borrowing to make an investment unless ultimately there's going to be some future period benefit in the form of enhanced income. So where is it? We should be experiencing very high rates of growth if this process was as simple as force the system or incentivize the system to leverage itself, take out lots of loans. I think what we're essentially experiencing, and now you have to think back to that chart that I showed a moment ago, is that so you sent the asset prices, so to speak, on Mr. Toad's wild ride. The asset prices have responded according to exactly what the central bankers would have said. The leverage rises, but not the income. And whether you're a household, imagine, once again, you're a household in this type of situation, even if your home price is going up considerably, if you're essentially extracting the equity and taking out leverage against it, and your income isn't rising, sooner or later something very bad is going to happen to you. The same is true of any corporation that essentially borrows to repurchase stock or to adjust its capital structure in a manner that is temporarily advantageous to the shareholder, and so too for an entire society. If you leverage yourself up to the eyeballs and you haven't produced more income, well, sooner or later you're going to have to deleverage it, and it's going to get nasty because that's typically when you also see significant declines in asset prices. And I think what we're describing in a very simplified way is essentially why the cycle lives and dies according to the amount of credit that's been created. They do die, and when they die, they die with a bang. So what you're looking at here are just some illustrative drawdowns, just because it has been a while since we've seen bear markets in some of the risk-based assets. So it's good to remember that essentially over a 3-month period of time, it's not that unusual to see 20, 30, 50% price declines in things like equities or high-yield bonds. When it happens very fast, and it happens severely. You don't, in my opinion, you never want to be on the wrong side of that. And the typical lack of worry that comes late in the cycle is that, well, when things start to go bad, I'm gonna be the first one out. Yeah, the problem is that people socially construct their decision making. So at the exact moment when you're getting out, everybody's watching you get out, and so are they. And the market typically lacks liquidity, and you start to see these rapid movements down. Our point here is that you prepare in advance. You have to reduce your risk, not in reaction to the drawdowns, but in a proactive way. Again, that's our view, our opinion about it. This is just meant to communicate that valuations look pretty strained. I mean, I'm not an equity market expert, but 22 times, as you see on the bottom, 22 times trailing earnings is, pretty much about as high as it historically has gotten. All right, so much for the conceptual thesis. I'll try to move quickly through why we feel that our view of risk in the marketplace is confirmed by reference to relevant factors and data. So we're going to consider, first of all, the biggest economy, which happens to be the US, obviously, the second largest economy, and between these two, I believe it's been the case that about 2/3 of global growth have been attributed to changes in US and Chinese GDP over the course of this cycle. So focusing on these two is probably not a misplaced place to be. And then finally, we'll make a few remarks about Europe, arguably the third largest economy out there. What we're putting forward here is that the US economy to us and the financial system looks late cycle. And again, maybe some of these charts will appear to be at odds with your own expectations or beliefs, but their data is always subject to interpretation. Why not consider the chart on the bottom left? So what we're reporting basically is the by golly collections of federal income tax from the corporate sector on a year-over-year basis. It's been negative for the last couple of years. Why is that significant? Look at the chart at the top right. No big surprise is that when corporate America encounters a period of deteriorating or shrinking earnings, its bid for labor, its bid for capital investment starts to fade. Now, historically, it is not shifts in consumption. It's a common statement that we hear is that 2/3 of the American economy is the consumer, and so if the consumer is in good shape, then don't worry about the cycle turning. Okay, it's not actually 2/3, it's actually more like 55% because a lot of what individual spend is actually imported and it deducts from GDP, but you get the point. However, it's actually fluctuations in business investment that historically determine the nature of the cycle. Consumption tends to actually be pretty smooth. It's nothing like focusing the attention of a corporate management on a shrinking stock price and a shrinking profit stream that basically gets the attention and the need to basically do things like shutting down plants and laying individuals off. Let's take a look at consumption. I mentioned a moment ago that it's probably not the place to look as a leading indicator, but it's a very significant chunk and portion of the overall economy. And also, I think from our point of view, you should think about consumption as almost a derived variable, which is to say that if you're an individual and your incomes are rising, you'll probably go out and consume more. So your consumption pattern is probably in many respects tied to the fortunes of the business that you're working for. What you're seeing in the top left is that, once again, the US Treasury is reporting that while it is collecting more individual income tax, it is doing so at a sequentially slowed rate. More disturbingly, or maybe more informatively, is the top right, is that if you were to consult the numbers as they relate to sales of things like big ticket items like automobiles, they're running at record levels. Look at the look at the blue line, however, in that top right chart. What you'll also notice is that the incentives, the buy down on the interest or actual promotions by the manufacturers is also rising very rapidly, particularly over the course of the last 6 months, suggestive that the demand for large ticket items like automobiles has actually faded, and that's further confirmed by a decline in used car prices. You can lower rates as much as you want to, and you can encourage people, for instance, to lease their automobiles, but at some point you will saturate elements of the economy like the used car market. And as you start to shovel more and more cars coming off lease into the used car market and you start to drive down the prices, which apparently is actually what's happening, as reported both by the auto manufacturers and the rental car companies and so forth, you start to reach a point where the lease terms have to actually start to get more expensive and less friendly to the borrower. So don't look at the big ticket items on the right-hand side, look at other forms of discretionary income like restaurant traffic. It's not doing actually all that well, okay? Maybe this is noise, but as we said, if you're just trying to take the temperature of consumption patterns, it doesn't look very strong to us. Labor market, according to the Fed, why it's doing wonderful. Okay, it's true, stated levels of unemployment are at fantastically low levels. Of course, while we don't show it here, that also comes against a backdrop of fantastically low, and I mean that very ironically, fantastically low levels of labor force participation. The Fed is very proud of the models that they build, the econometric stuff that they put together. Their dashboard, which Janet Yellen speaks to from time to time on the bottom right, indicates, according to them, that according to their most mathematically pure models, that the labor market doesn't really look all that strong to them. More significantly, there's been a decline in hours worked, and if you looked at the top, you see that the decline in hours worked on a year-over-year basis is pretty broad-based. The only place where you're seeing strength, and that's against a weak year-over-year comparison, is in the energy industry, energies and mining. But overall, again, labor market is, I think you kind of shrug your shoulders. Doesn't look like it's booming. One development that has been continuously occurring, of course, in recent months is the flattening of the yield curve, the shrinking spread between 2-year treasuries and 10-year treasuries. That seems maybe to some kind of abstract, like who cares about it? Well, any financial institution is in the business of borrowing short and lending long. So as you compress the spread between short and long rates, you start to take away the incentive to create loans. If there's less spread, then I have to basically either shrink the number of loans that I extend at a given level of underwriting, or I have to lower my underwriting standards and take more risk in order to maintain the income level. So typically, and as you can see, with a lagged effect, those are what those gray bars obviously mean, is that when yield curves go flat and inverted, just kind of look out below. That tends to be the end of the cycle. So these charts are kind of interesting. What you're looking at on the top is the trend in bank lending. Okay, now bank lending isn't all the lending there is. There's capital market lending, obviously, but just look at the banks for a moment. So what you're seeing on the top left is the quarter-over-quarter change. It's flatlined. It's gone to zero. Again, I don't know whether that's going to rebound. It's confirmed by the earnings reports of all of the money center banks, all of which basically reported essentially no growth in their C&I lending book. On a year-over-year basis, the numbers look a little bit better. Why has lending suddenly collapsed? Is it something that's going to continue? Who knows? But it's not, again, a sign of underlying economic strength. In the commercial real estate market, you're seeing a similar trend as well. I mean, again, there's been a higher rate of growth of commercial real estate lending, but our understanding is that the regulators have basically gotten over the banks over the course of the last 12 to 18 months to start being much more careful about the kind of commercial real estate loans that they make, because commercial real estate suffers from the same problem that the rest of the financial economy does, which is the prices keep going up, but the net operating income, the rents that you get from your customers who are renting your properties, is not. And consequently, one would think that the risk level has gone up. So from our point of view, I think that this is a very interesting chart. If you could, I guess I would direct your attention to the top right. And what the top right is showing you is essentially the amount of leverage by cohort that exists in the US investment grade credit market. Okay, you're looking at leverage now here on a gross basis, meaning that we're just looking at how much debt you have and how much earnings you have. We don't care whether you're Microsoft and Apple and you have big books of cash. We're going to adjust for that in a moment. What the chart reveals essentially is that the median US investment grade company is now experiencing about 3 turns of leverage. So why does that matter? Well, traditionally, if you take Moody's, S&P, and the rating agencies at their word, they will typically say that investment grade means 2 turns of leverage, maybe 2.5 turns of leverage, and by the time you're at 4 turns of leverage, you're a high yield, below investment grade, junk company, whatever word you want to use. What we have migrated to over the course of the last couple of years is an arrangement where it appears that half of the US investment grade universe is already arguably out of tolerance with traditional rating agency standards. And the most charitable thing you could say about it is that if there is a profit hiccup, you should expect the rating agencies to get very active and downgrade a lot of companies. And that will put a lot of stress potentially into the credit markets generally, in the high yield market in particular. If you look at the bottom left, I'll only refer you to the left line and then reference back to the left axis, is that, well, we talked about gross leverage. What about Microsoft and Apple and all the cash that US companies have? Well, what these numbers are showing you is that if you follow the blue line against the left axis, is that while the absolute number comes down to about 2.3 turns of leverage, you are notably higher than when you were in 2007. You're higher than where you were in 2002. You're higher than where you've been in a very long period of time. So is that something to worry about? Well, some would say don't worry about it because, after all, the level at this low level of interest rates, maybe the coverage ratios, maybe that you're earning enough income to pay your bills anyway, even if you're up to your eyeballs in debt. What the top left chart shows you is that, at least in the case of the high yield market, it's not so, is that essentially your coverage ratios have been coming down sequentially. They're back to where they were in 2007. We get asked this question periodically by clients that understand that we are at a defensive point in the cycle, and they say, but we want some more yield. How about high yield bonds? What about those? Well, one way to step into the discussion is look at the default rate. Now, there isn't a default rate. Some people will report the default rate in the high yield marketplace based upon the par value of bonds outstanding. Some will do it based upon issuers. Oftentimes, companies that are in trouble do so-called distressed debt exchanges, where basically they do the legal equivalent of pointing a gun at the bondholder's head and essentially say, I know your bond says that we owe you 100 cents, but basically we're going to blow your brains out. We're going to go into bankruptcy unless you accept 50 cents. So take your 50 cents or we'll work this out in bankruptcy court. So some will consider those defaults, others will not. Doesn't really matter. If you look at the valuation proposition in high yield, people are very good at quoting, here's the yield, here's the yield, here's the spread, here's the spread. Okay, yield is inherently a forward-looking type of proposition. If you're just looking at the quoted yield, then you have forgotten the fact that some percentage of the loans that you make are not going to come home. They're not going to mature. So if you take the current high yield spread, you impute a default rate of 3%, which, as you can see, however you want to measure it, looks a whole lot better than where we have been. And then you impute some assumptions about how much you get back when you do default. You don't get 0 cents back. You typically get 40 cents back. Anyway, the point is that the premium that you get to invest in high yield, when you loss adjust it and compare it to things like investment grade debt, the proposition doesn't look very appealing to us. Okay, so much for the argument that the U.S. economy is late stage. Let's talk a little bit about the China model, the second largest economy on earth, and how do we make assessments about it? And the short answer is I don't know that anybody really knows all that much about the China economy, and I'm not going to stand up in front of this audience and say, that we're some kind of experts. The data typically isn't very good, but I think that there's some very broad statements that you can make about it. The first broad statement you can make is that as impressive as the growth in GDP has been over the course of the last 10, 20 years, the growth in leverage or debt creation has been even more phenomenal. So that's just, I think, something to put in the back of one's head. We look to try to determine what the source of inquiry was, or what underlied Citigroup's statement from approximately a month ago that 80% of the world's private sector credit creation is coming out of China. The data that they use is proprietary. They wouldn't disclose it to us, so I can only put forward as a statement and assertion. If it's true, even if it's even approximately true, even if it's 50%, I would say you should be very afraid, because obviously China is not 80% of the global economy. If that much credit is actually being created in China, and it may be, then you have an unsustainable growth model. What we put forward here is that when a society creates lots of leverage, the loans have to go somewhere. Somebody's holding them. And the typical place that you hold them is in your banking system, particularly when you are not the US, which has very well-developed capital markets, but most parts of the world operate basically with very bank-centric type of credit creation. In 1987, when Japan was in the midst of its bubble, its real estate equity bubble, of the 10 largest banks in the world, all 10 of them were Japanese. Okay? When you look today at the 10 largest banks in the world, number 1, 2, oh, excuse me, I was going to say 1, 2, and 3, I'm wrong. 1, 2, 4, and 5 are Chinese banks. Compare that with the likes of JP Morgan, Bank of America, not shown here because they're smaller, obviously, would include Citigroup, Wells Fargo, et cetera. So again, it should just tell you there's a lot of paper out there. The chart here is meant to convey, again, sort of the obvious point, which is that the efficiency by which credit inputs are turning into GDP outputs in China seems to have come down markedly. That, as we put it, I mean, again, this is kind of a simple-minded way of maybe presenting the data, 22 units of additional credit creation per unit of balance sheet, which means your system is getting levered up with abandon, essentially. And what we put forward here is that when you look at the two charts on the bottom, if you see that a lot of the credit is going into housing or into mortgages on the left-hand side at the bottom, and then you compare that with the response in Tier 1 cities in China and the growth in property prices, you might be tempted to say that maybe there's a connection between all of this credit creation and the growth in property prices. Certainly was the case in the American experience in the last cycle or the Japanese experience in the 1980s. It's perhaps instructive. What we put forth here essentially on this page is that there are different ways to characterize it, and we're not showing it exactly on this page, but I'll get to the point here, is that part of the magic, I think, of the Chinese growth model over the course of the last 20 years has been that there has, in fact, been a lot of credit creation, and it went into highly profitable activities. It built factories that essentially found export markets, and that drove essentially growth. Or maybe if you want to put it another way, is that you were transforming labor that was generating income maybe in a subsistence or semi-subsistence capacity that was in effect drawing on compensation of $1 a day, and start putting it to work at $2 to $3 an hour. That type of economic growth, when you aggregate it across many millions of people, leads to very large numbers. But the suggestion here is that isn't it ultimately dependent on the key element of your economic model, is that if you are devaluing your currency but not finding additional markets for your exports, that's a forward-looking statement. I'm not saying that it's a conclusion, but it does suggest essentially a risk factor, that there has certainly been some loss of market share on the part of the Chinese export machine over the course of time. Again, maybe history is an interesting teacher. So if you channel your inner state council economic policymaker and think, well, what can we do to maintain or maybe even accelerate Chinese growth? these are maybe some of the things you could do. So first thing you could do is say, we got to get our exports back and we got to get them growing more rapidly again, so we could devalue our currency. Those that remember the history of the Asian financial crisis in the late 1990s, in 97 and 98, that's exactly what Japan did, is essentially growth slowed. So the Japanese devalued their currency from approximately 110 to the dollar to about 150 to the dollar. And while Japan started to take market share from everybody else, well, that's the whole point. You took market share from somebody else. So essentially, you exported your problem as you deprived others of their income, in effect. And we are, at the moment, also living in a 0% world growth trade type of model. You have the potentiality of precipitating a crisis elsewhere, as the Japanese did. It took about 9 months to get there, but Thailand, Korea, and others were in a stage of crisis brought on by the fact that Japan had essentially made its competitive dynamic stronger. That's one direction you could go down, maybe not a particularly good one. Another way you can go, and there seems to be elements of this also, is that we don't want to devalue the currency, we want to maintain it. But it naturally does want to go down, and so we will resist the pressure to let it go down. There seems to be an incredible bid or desire on the part of those with capital in China to get it out. And consequently, that probably is instructive as anything as it relates to their own expectation about the relative value of holding RMB in China versus getting it into some other currency and holding some other asset class. But you, as the state council member, you can fight this. You can impose capital controls as they have. The problem with it is that the result may simply be a continuation, maybe a controlled, but a continuation of a slowdown in growth in China. An interesting observation is, as you see there, I don't need to read it to you, is that 50% and more of many of the world's key commodities get eaten by the Chinese export engine. Should there be a decline, then, well, let's think about what happened to the price of oil and other commodities about 15 months ago. You might get some type of response like that. Or you do what central bankers and politicians typically do everywhere, which is that you just say, well, we don't want any problems on our watch, and maybe if we keep kicking the can, maybe there won't be any end to the road. So you just keep doing the same thing. You just keep piling on the leverage and just hope that it never will come to an end. The future will never arrive. We'll make a very brief discussion about Europe. And some of these remarks, I think, will be kind of longitudinally a little bit longer, because I think that the problems in Europe, while they were acute a couple of years ago, they're really just chronic issues. And the chronic nature of them means, in our minds, a couple of things. First of all, is that Europe isn't going to be of any help to the global economy, and it remains at risk to adverse conditions somewhere in should there be a ratcheting down of growth anywhere. And of course, as the last speakers underscored, is that it's also causing simmering issues in the political field as well. What we present here is, when you look at the bottom left, is that every decade since World War II, essentially, the dynamic that existed in Europe is that if you were going to stay competitive with Germany, you had to devalue your currency. And essentially what you're looking at is the cumulative devaluations during those decades. That was the way you essentially allowed your productive, your economy, which I'll describe as essentially a constellation of labor and capital all put together. The only way it stayed competitive was through the devaluation process. Along came the euro circa 2000, and no longer could you devalue. So you know what happened? Look at the right-hand side. That's what happened, which is to say that if you were in Germany, your labor costs grew relative to Germany, and you became more and more uncompetitive with Germany. However, at the same time that this terrible thing was befalling your Main Street economy, your quote-unquote, your Wall Street economy, was offered cheap borrowing costs through the euro. And so what does that mean? Well, rather than fix your labor market, fix your product markets, make your economy structurally better so that it can compete with Germany, the social choices that were made in Europe were, no, let's just borrow the money. But this chart in Spain is probably as good as any. Peripheral Europe essentially maintained their living standards since the euro was created by reference to this type of dynamic. But if you create a lot of leverage, it's got to go somewhere, just like we said about the Chinese banking system. And there it is. It's right there on the bottom. It hasn't gone anywhere. Now, I've had the experience from time to time to be in Europe and to speak with bank CEOs and folks that are plugged into policy making and high up in government. And the party line is that, well, you don't really understand, this is Europe, things move slowly, but give it time and the problems are going to fix themselves. And of course, it's not my place to say or offer different opinions, but just to listen. That's why we have 2 ears and 1 mouth. But in my head, what comes to mind is a chart like this, because for every problem loan that your bank has is a troubled asset. Essentially, the only reason you have a bad loan is because you have a bad business, is that there's a business on the other side of it that is not growing, is unprofitable, and essentially is using labor and capital inefficiently. So how are you going to grow your way out of your problems when your problem loans, in a sense, are the problem? You're going to have to do what capitalism evolved to do a long time ago, which is that the bankers have to get mean, and they have to say essentially that your business stinks, you're using resources poorly, and it's time to pony up or go into liquidation or restructuring. Nobody wants to hear that because it brings a lot of social and political pain, and the result is that, well, fine, then you're going to leave all your resources in formats and with businesses that essentially have no ability to grow. Meanwhile, your banking system basically sits there just waiting for some type of taxpayer bailout at some point in the future. Okay, so with all of this gloom and doom, and I probably should have apologized at the beginning, because every bond manager you probably meet, and maybe we're worse than others, is probably going to give you 10 reasons why terrible things are going to happen in the world. We're all going to die, and the cycle's going to end and befall us. But underneath this message actually is a message, I think, I like to think of it as sort of prudence and intelligence, which is that you're not here to imagine the world the way you would like it to be, but just understand it the way it is. It does actually run in cycles. And if you take the asset class of high yield bond investing as a typical example, what many who have worked with the asset class intuitively recognize is that for the first 2 years at the end of a recession, you get monster returns in high yield. You think, I'm a genius. There is no better asset class out there. I'm earning 40, 50, 100% a year with what I'm doing. This is great. I'm buying bonds at 20 cents on the dollar, and they're going to 60 and 80, and they're paying me coupons. And then for the next 5 years or so, you're buying bonds at 80 cents on the dollar, and they're paying you 8% coupons or 6% coupons, and it's pretty good. And then you get to the end of the cycle, like now, where much of the asset class is trading above par, only waiting, essentially, we would put it, to be repriced back to 20 cents on the dollar. And people who have ridden that trip down are like, I wish I'd never heard of the asset class, and I wish I'd never put a penny into it. And I think what we're really saying is that it's not good, it's not bad, it's just that it's appropriate at certain times of the cycle and not at others. And with that thought in mind, what we present here, and this will be the last chart I mercifully cover here, is that this is kind of a roadmap for thinking about your investments, at least in fixed income and maybe beyond, at the end of, during that last 20% of the cycle. It's essentially to recognize this, that cycles die in large measure because capital gets tied up in unprofitable enterprises. So think about, in the last cycle, think about investments in subprime loans or in Lehman bonds. In this cycle, think about investments in bricks and mortar retail or investments in coal companies or fracking businesses, essentially. Those are what form the breakable asset class. And that's the stuff that you have to think about very proactively, like, how do I identify it and how do I get rid of it before basically it breaks? I mean, there may be a time to own breakable assets, but after they break and not before. Meanwhile, you got to do something with your money. You can't just hide under your desk and put all your money into the mattress. That's not much of a solution either. And so what we're counseling here is essentially is that divide your assets between what we'll call traditional risk-off investments like treasuries and other things like that. Now, do you own them because of the fantastic arrangement of buying 10-year treasuries at a 2.2% yield? Can you retire on that? Can you do anything with it? The answer is no, not really. But you can own them tactically, and the reason you own them tactically is to finance an expansion of your bendable assets. Is that while I focus on the gloom and the doom, the reality is that no matter how bad a deleveraging, a recession, a bear market, whatever word you want to use to it, is probably 90 or 95% of your claims survive to live into the next cycle. So almost everything that you do own, if you can bear the marking-to-market volatility, is going to experience what a banker will call a temporary impairment, not a permanent one. So you buy your bendable assets, things that will survive the cycle, top of the capital structure, AAA commercial mortgages, asset-backed, some of the other things that we reference, even including investment-grade credit. That gives you some yield, so you can eat something while you're waiting for something worse to happen, a deleveraging. You own your risk-off assets. When the inevitable comes, you'll sell some of your risk-off assets, and you'll buy some either broken assets or additional bendable assets. So as I said earlier, our point was to share our views, our thinking about it. Doesn't mean that it's right, and others may have other points of view, but that's, I think, all I wanted to subject you to. So thank you. Yeah, I mean, you raised the sort of the foundational question, which is that even assuming that the analysis is right, it can still ultimately at some point not be relevant because what we're dealing with, and I think this is something that I tried to hint at, and I don't know that I made it so clear, is that economics finance is not science, okay? I mean, it's made out to be that way, and central bankers like to talk about it that way, but the reality is that it is a socially constructed activity, and people make their judgments about how much risk to bear, based upon a myriad of factors, but not the least of which is the amount of risk-bearing tendencies they see in the people to the left and to the right of them. So there are two things that you can take away from that, is that on the one hand, what people I think are basing their judgments on is a sense in part that the central banks are these powerful technical forces. They go and they buy lots of bonds. They've been doing it in Europe, supporting rates in Japan, etc. The sobering part of it, however, is that in the event that individuals recognize that the risk-bearing capacity is not, in fact, unlimited, and it is contingent on the changed perceptions of others, it tends to happen very quickly. And we've seen already, at least two examples in the last 18 months that I think, should worry you. Do we remember August of 2015 when China gave this tiniest drop of hint that maybe it was going to revalue the RMB down? And I remember coming in and Dow futures were down 980 points, essentially, on that little tiny, snippet of news. It's true, markets, bounced back. And at the end of 2015 into early 2016, the equity market took a major nosedive predicated on a decline in commodity prices and fears about global growth. So I want to put it this way, is that we're not going to change our view, based upon shifts in what individuals think about the fundamentals. We're going to ground it in the fundamentals, but you put it nicely. I mean, we've been wrong for a couple of years, and maybe we'll be wrong for years more. I hope not, but it happens. Yes, sir.
You're given a half an hour to go to the Trump administration and sit down with, luncheon and the whole crew. What would be your big theme or message to the administration?
Well, I'm probably the last person they would want to, consult for, for anything. But I think that, I don't know whether the Trump administration, in particular, is focused on this issue. I don't know, and I don't want to comment on it. But I think that the notion of bringing down the corporate tax rates, which has been discussed and was emphasized today. I mean, of course, Wall Street guy, thinks that that's a good thing to do. But in a global economy, capital goes wherever it wants to, essentially, wherever it feels most welcome, or more particularly, wherever it thinks it's going to earn the highest return. Tax it and it runs somewhere else. So there's a lot to be said to trying to fix the economy in a more bottoms-up capacity by shifting incentives. And I mean, I'm not really responsive, I think, maybe directly to your question, but I think that would be one important direction to go in. And then it's part of at least the institutional memory of some number of people here, is the experience of the 1980s. I mean, those of us who grew up in the 1970s kind of remember almost the despair that existed in this country. You know, this belief that the economy was foundationally broken. I mean, I grew up in New York City in a time when people said, "Get the hell out of here! You know, you don't want to live here any longer, and you know, you should move to Brazil or something. Just get out of the country." But in point of fact, the country somehow found a way to self-correct and start to fix its issues. And I'll be preachy for a moment. Is that I have oftentimes tried to make a point, professionally and personally, that being smart, whatever that means, is a nice trait to have. But the thing that actually distinguishes individuals from one another and distinguishes societies from one another and businesses from one another is the capacity to self-correct and to just say, you know something, this isn't working, it's screwing up, we have to try something, we have to experiment and see what will do better. I think that the Trump administration represents the political market experimenting, you know, essentially saying, I've heard what this group says, I've heard what that group says, and you know, the electorate essentially spoke and said, neither one of you, I think, has got an answer that's relevant for me, you know, whether we agree with that or not. And so the political market says, you know, in effect, let's see what happens.
Thank you for your helpful comments. Maybe could you respond to maybe some of the more positive narrative out there about CEO confidence and consumer confidence spiking, whether that's a leading indicator or if that's maybe just a false start, if you will, and more broadly on the character of this recovery that we've had, that it's been sort of without animal spirits, it's been sort of hated over the past few years, and just sort of the lack of growth capex out there that maybe this growth agenda might bring in sort of animal spirits and a real recovery. How do you think about that?
Yeah, I mean, maybe unstated and slightly, you know, again, I don't want to be pedantic about this, but you reference animal spirits, which is a sort of a very classical, sort of Keynesian way of, you know, thinking about the economy. Because if I'm of high spirits and I spend my money or I invest my money and everything I spend becomes somebody else's income, there's an alternative way of looking at the world. And I think that worldview, which is very inculcated in, if I can put it this way, I think in the American mindset as it relates to the American economy, is derivable from a time when the American economy was unparalleled in terms of its competitiveness. So if I'm high-spirited and I'm spending and investing domestically, and I'm ginning up economic activity domestically. If I feel high-spirited and my economy is not actually all that efficient and competitive, the demand leaks, and it stimulates somebody else's economic growth. And I think that that's part of what's been missing from the understanding in the equation, that it's not 1955 or 1985 any longer. The US economy is now very different in terms of character. So the way I would frame the question is why doesn't an economy grow? And I think that the simple answer is because individual workers and individual businesses figure out a way to be more efficient, 1% more efficient, or 1% more value added every single year. And that adds up over the course of time into productivity increases. But you have to show the way. You have to have you know, good incentives and the type of economic structure that facilitates and allows that grassroots issue to come. So sort of like the big answers, like we need a program for this and a program for that. You know, I think historically they have shown themselves to come up very short. And again, maybe I'm waxing too eloquent, is again, remember the 1980s. I mean, I remember entering the workforce in 1981 as an engineer and hearing that American engineering companies can never compete with Japanese engineering companies. They cannot. You know, you don't understand it. It will not be until American companies, you know, start to create coaches and teams and group exercises and changes everything about it. But the reality is that all of that stuff was actually irrelevant, you know, to the issue at hand. In the 80s, the solution was, we called it Reaganomics. We would probably call it structural reform today, which is that how do we make people make their capital and labor be put to higher and better uses? And the answer traditionally has been we at the sort of the, you know, running the economy at this level or at the politics at this level have no idea. But if you devolve it to the grassroots, deregulate it and cut taxes, It generally has had good results. Would it this time? I don't know. But the soft data and all of the consumer confidence, my opinion, it's not very dispositive towards telling you where you are in the overall cycle, or even particularly encouraging. But we could be misreading that.
What would your view be on secured leverage loans? Would you package that in with high yield debt? I mean, they're secured and typically recover, I think, around 80 cents in the dollar plus floating rate. So given the thought that rates are rising, do you have a different view on those? As well, maybe what are your views on CLOs? Do you probably package them into your, if they're AAA or AA or something, maybe invest in those tranches, but not the lower rated ones?
Yeah, so I mean that's sort of a big question, because secured and widely syndicated bank loans. So basically, this market came into being over the last 20 years. Banks don't hold a lot of the loans that they originate. They sell them to asset managers. They are usually, as you point out, they're well secured. They often come with strong covenant packages. So they typically are what I would describe as bendable assets. Even when they go bad, they oftentimes recover close to 100 cents on the dollar. So that typically is a good place to be. Although you do want to be careful. There's first lien and second lien loans. You want to make sure you're at the top of the claim structure. As it relates to CLOs, well, you have the loans go into a trust structure, and then they get retranched from AAA all the way down. Do you want to be at the bottom of that? I would say no. The AAAs, do you want to get, for a AAA bond, you get LIBOR these days plus 110 or 120 basis points. There's a lot of flow of funds into it. A lot of it, ironically, is coming overseas. Again, this is part of the technical support, is that the Japanese investor says, I can buy Japanese T-bills at minus 40 basis points, negative yield, or I can throw it into the US dollar market and buy probably overvalued, but ultimately survivable investments like that. So I don't think that we're not like viscerally against the idea of buying those AAAs or buying bank loans, but I think we would just sort of say it's kind of an inflated market. Thank you.